Staying with our conversation on today's Fed meeting, let's welcome in Emily Roland, a co-chief investment strategist at John Hancock Investment Management. Emily, a big day here as we look to the last meeting of the year, or a last decision of the year from the FOMC. We saw yesterday the markets rally a bit on the back of that CPI print that came down, but we did see a bit of a pullback towards the close. What do you want to hear from the Fed chair today?
Yeah, Akiko, it's a big day today. We're expecting to see the Fed moving from this pattern of 75 basis points to a 50 basis point rate hike. You know, the summary of economic projections is going to be critical. That's what we're going to be doing, refreshing our screens to see what the Fed says as far as the terminal rate goes. During the last summary of economic projections, the Fed had showed about 4.6% was what they expected, where they expected to stop in 2023. The bond market is now projecting that the Fed are pricing in a terminal rate of 5%. So does the SEP start to reflect that? And what are the Fed's views on GDP? Last time they penciled in 1.2% for GDP in 2023. It's not hard to see how the economy continues to accelerate given this incredible amount of tightening that the Fed has put into the system. And finally, we'll be watching, of course, the press conference with bated breath. It'll be interesting to see if Chair Powell pushes against easier financial conditions. The Fed cannot be happy with the fact that financial conditions remain really easy still. You've got the dollar weakening down about 5% from its peak. You've got high yield spreads barely budging to reflect elevated recession concerns, and you've got the S&P 500 rallying here. We're only down 14% year to date, and all of that has come from multiple expansions. So we'll be really listening closely to see what the Fed's response is to that.
And we know that Powell really did hone in on this issue of wage growth and the tight labor market being really the sort of make or break part of inflation here. Can the Fed, though, successfully bring down inflation at the pace that it wants to when you still have such a tight labor market?
Yeah, it's going to be really tough. Every jobs report that comes in is just too hot for the Fed to handle. And we need to see wage growth come down. One of the biggest challenges for the Fed has been the fact that the participation rate really has not gone up. So there's a lot of work that's been done to try to understand, you know, the effect of COVID and how that's impacted the labor force, why people aren't returning to work. And that has been very, very stubborn and a reason that we haven't seen wage growth pressures come down. So I think the Fed's going to reiterate today that there's still a lot of work to do. They have been unwavering in their commitment to bringing down elevated inflation. And yes, we did see a nice kind of continuation of the pattern in terms of the pace of the inflation data coming down a bit yesterday. But look, headline CPI still has a 7 handle on it. We still have an inflation issue here in the U.S. We do expect inflationary pressures to subside and do so quickly into 2023. In fact, if you do the math, and we keep on the pace of a 0.1% increase on a month over month basis, you're below 2% by June of next year. The challenge, of course, though, is that the Fed is very much focused on backward looking data. They're looking at unemployment. They're looking at CPI. Those things take time to show up. We look at the leading economic indicators, and they've decelerated for 4 consecutive months, suggesting that a recession is imminent. So the Fed is probably going to go too far, too fast here to avoid a recession in 2023.
Well, Emily, I mean, to that point, the leading indicators there are really key in sort of guiding the market in terms of where this is likely to move. When you look at where that data is going, I mean, especially if you look at something like the yield curve, what does that suggest in terms of where the terminal rate is likely to end up at?
Yeah, it's hard to imagine a yield curve inverted to the tune of 72 basis points, which is where the 210 spread is as of this morning, not leading into a recession. So we do think that the market might be right around 5% terminal rate for the Fed funds, but the bond market is now pricing in 2 rate cuts in the back half of next year. And we think that's right. You know, the Fed has a dual mandate, as we all know. They set monetary policy based on maximizing employment and maintaining price stability. And they've just been tackling the price stability half of their mandate this year. And we think that that's split next year over to the employment side of their mandate. And the Fed's going to need to be cutting rates as the unemployment rate comes down. Now, the good news is that'll probably mean the start of a new cycle as far as risk assets. We see the Fed start to cut. and we could be off to the races again in terms of risk assets starting to do better. Bonds, we think, will work well in a portfolio. So we think a balanced portfolio is going to be alive and well, but there's probably going to be some choppiness and bumpiness until we can get there.
And Emily, you pointed to the potential of 2 rate hikes next year. When do we expect that to come?
Yeah, so the bond market now is pricing in 25 basis points in February and then another 25 in March and then pause. And then again, those 2 rate cuts in the back half, September and December of next year. That is a lifetime away. You look at some of the Fed projections from a year ago and you almost kind of laugh thinking about them. We never thought that the Fed would tighten to this extent, nor did the Fed itself. So that's still a ways away, but that we think directionally is where the Fed goes into 2023.
I'll certainly be listening closely at 2:30 when we get that press conference. A big thank you to Emily Roland there, Co-Chief Investment Strategist at John Hancock Investment Management.